Hello, everyone. I hope you're doing exceptionally well. Today, we're going to cover the negatives of infinite banking in Canada. Kind of before we begin, I plan on making a series of videos. I figured it was best to start with the negatives of infinite banking before we actually start about the positives, because ultimately, if you can't get past these negatives, then the positives really won't matter. A little bit about me. I'm not a life insurance agent. I don't sell infinite banking products. I simply just want to provide a little bit of education on the infinite banking concept, becoming your own banker, you name it. And I will say that I do practice infinite banking. And so I'm not coming at this from a place of unknowns. I practice this in my daily life, and I hope to give you a little bit of information and education on that. So let's dive right into it. So the first negative of infinite banking is the upfront cost. Now, whenever you listen to infinite banking videos, you're going to see very often that these upfront costs are often associated with the cost of creating a business that is your banking business, which I mean is a good way of putting it, but ultimately it's a cost, it's a fee, whether it's a fee on a mutual fund, a fee on a anything you do, really, it is a cost. Now, the cost can be quite substantial, and this upfront cost really only matters if you cancel your policy. Tidbit of information for those that don't know, the infinite banking product that is used is a specially designed whole life insurance policy. And when they say specially designed, what they mean is they mean the lowest death benefit, but the highest amount of cash deposited into the account. And I'll go through illustrations in a future video so you can actually see this in action. But ultimately, when you're talking about it, sometimes you can see upfront costs, which means if you deposit, say, $10,000, let's say, all right, you can see sometimes these upfront costs ranging anywhere from like approximately 20 to 30%. Right? Maybe sometimes a little bit lower, sometimes a little bit higher. But that means at the end of your first year, if you deposit $10,000, you will actually only have $7,000 to $8,000 actually usable approximately. Okay. That would be your cash surrender value. So there is a little bit of an upfront cost there. You just have to be aware of it. The next negative that you have to be aware of is it's really a long-term commitment. This isn't something that you start in 1 year and decide to not doing it the next. You're typically talking about a 10+ year plan. Now, when you think of infinite banking and you listen to a lot of videos, people talk about this being a lifelong journey of creating your own bank. And I don't disagree with that. But it doesn't have to be, it does not have to be a lifelong vision or funding plan. You don't have to keep making premium payments for the rest of your life. And again, I'll get into that in a future video. But it is something that you do have to realize that if you're only going to do this for a year or two and then bail, well, because of problem number one or negative number one, you are going to take a loss, right? And no one likes losing money. So yeah, that's that. And the third negative, and here, let me clear my board here. So the third negative is that it's really out of the box thinking. Now, is this really actually a negative? I don't think so. I think once you start thinking out of the box and start realizing what you can do with some of these infinite banking policies and the process itself, it is absolutely mind-blowing. So some of the things that you have to get over is why would you borrow from an insurance company at a rate higher than you can borrow from a bank? Right? Why would you do that? That doesn't make any sense, right? Well, I'm going to tell you it does make sense, and I'll explain it as we go on through this series of videos. So make sure to subscribe to the channel and like and comment below what your specific questions are, so we can get over that, right? The second one has to do with the actual, I don't want to say cost of the policy in the sense of the amount of money you potentially lose, but the amount of money that you put into the policy, right? So your basically your premium requirements, if I'm going to put it that way, premium requirements is more better, is less better. How much should we do? I want to make it the most efficient policy ever. There's a whole lot of concerns that come into that in the sense of how much money you want to contribute long term. Long story short, This is a process by which you take out, you have your cash that you receive through whatever you do. Most people, what they do with that cash is they stick it in a checking account and then they go ahead and they spend this money. But what we're going to look at doing is basically when you receive cash, you're going to put it into an insurance policy, essentially IBC policy, and then you're going to go and spend it. It's a different process. All right. And a lot of people can't figure out, well, why would I do this when I can do this and this doesn't cost me any dollars? Well, the reality is because you ultimately obtain control. Anyway, I just wanted to go through those three quick negatives: the cost, the long-term commitment, and that you need outside of the box thinking. I really don't think there's other negatives to this. And actually, to be quite frank, I don't think the negatives in this situation are all that bad. The reality is that the money that you would lose potentially is far less oftentimes than the negative than the risk that you take on the stock market, or at least comparable risk that you take on the stock market if you're big into investing. But anyway, everyone, I'll leave it there. Subscribe to the channel if you want to keep seeing these the series, and otherwise, we'll catch you in the next video. Have yourself a wonderful day.